We have reached the halfway point for 2023 in what has been a memorable first half for the S&P 500. Year to date, the S&P 500 is up 15%. 15% in a full year is a tremendous year. 15% in just a half year is outright insane. Where do you think the S&P 500 will finish the year? Higher than 15% or lower than 15%? Let me know down in the comments section down below. This is something that we talk about on a regular basis. In fact, on a weekly basis during my live stream titled The Dividend Power Hour, which you can join every Thursday at 7 p.m. right here on YouTube. During the Dividend Power Hour, we talk economics, we talk macro environment, we talk stocks, and yes, we talk dividend stocks. Hope to see you there this Thursday at 7 p.m. Eastern Time. With that being said, a lot of this run appears to be a little overdone, especially when you're looking at the technology sector. It makes this S&P 500 run look a little one-sided, and one way I can tell is by looking at the equal-weighted S&P 500 ETF, stock ticker RSP. This is equal weighted across all 500 stocks, whereas the regular S&P 500 is market weighted, and it's very top heavy. At the top, you see large exposure with Apple, Microsoft, Nvidia, Tesla, Meta, all of those, Google, all of those names at the top of the S&P 500, and these companies have led the charge. So we saw the S&P 500 up 15% year to date through the first half of the year, but when you look at RSP, it is only up 4% through the first half of the year, and that is a very wide gap that is not usually that wide. What this means is the tech sector in particular could take a bit of a breather, but it also tells me that there could be opportunities in many other sectors that have been kind of left behind in this market run that we've seen through the first half of the year. And with that being said, in today's video, we're going to look at 5 top dividend stocks for you to consider buying in your portfolio for the month of July. But before we do that, let's recap how our stock picks did in the month of June. Looking at this chart, you can see that Qualcomm was our top performer, gaining 8% during the month, followed by Johnson & Johnson gaining 6%. AT&T was up nearly 2.5%. United Health was flat as they started off strong but then endured a sell-off mid-month, and Tyson Foods brought up the rear but was only down 3% on the month. So overall, a pretty solid month of picks there. And if you're ready to go over the top 5 for July, do me a quick favor. Hit that like button down below as it truly helps the growth of this channel, and I really appreciate it. And with that being said, let's get started. Hey everyone, Mark Rusin here. As always, I'm a CPA and not a financial advisor, so please perform your due diligence, as these opinions and stocks that we go over today are my opinion alone. So please perform your own due diligence before investing in any stock mentioned in this video. And we would like to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Check out the link down in the description below. Now let's go over our top 5 dividend stocks for the month of July, beginning with July dividend stock number 1, which is Qualcomm, stock ticker QCOM. Qualcomm, as you know, is a semiconductor company, and it is actually a carryover from prior month. As we just looked a moment ago, Qualcomm was our leading performer, up 8%, but even with that, the stock still has not fully participated in that AI craze. Looking here at this chart, you could see the 12-month performance for many of these other semiconductor stocks. Nvidia has been leading the charge, up an astonishing 142%, followed by Broadcom, up 65% over the past 12 months, with much of that coming recently. AMD is up 26% the past year, and Micron is up nearly 15% in the past year. And then we have Qualcomm down 5% over that same time period. Qualcomm has a great portfolio to be able to turn things around, and in the meantime, this provides a great opportunity for us long-term investors to add to the position. We're talking about a company that has some of the strongest technology. We're talking about 5G and their handheld devices. We're talking about automotive and the opportunity within self-driving. We're talking about the ARM processors, in which they compete directly with Apple that go into laptops. And then, of course, we're talking about AI. All of these segments have great opportunity for growth moving forward, but one of the drags on the company of late has been one of their largest sectors, and that has been with handheld devices. And a lot of that has been known and seen across the globe of late. So why not take advantage at these low prices, right? Qualcomm has a market cap of $130 billion, and over the past 12 months, as we mentioned, the stock is down 5%. But year to date, they've bounced back and the stock is up 11%. In terms of dividends, shares of Qualcomm currently yield a dividend of 2.8%, and they are well covered by a low payout ratio below 30%. The company has been increasing the dividend for 20 consecutive years, and they have a 5-year dividend growth rate of 5.2%. Looking at valuation, analysts are looking for EPS of $9.57 per share over the next 12 months, which equates to a forward multiple of 12.2 times. Over the past 5 years, for comparable purposes, shares of Qualcomm have traded at an average multiple of 18.7 times, and over the past decade, closer to 15.5 times. Analysts rate the stock a moderate buy with a 12-month price target of $135 per share, indicating nearly 13% upside from current levels. July dividend stock number 2 is Amgen Incorporated, stock ticker AMGN. Amgen is one of the largest biotech companies out there, and they're also one of the oldest, having been founded in 1980. Amgen has a market cap of $119 billion, and over the past 12 months, the stock is down 9%, and year to date, even worse, down 15%. Amgen is also part of the Dow Jones Industrial Average Index, and investing in Amgen gives you global exposure, as many of their products are sold all over the globe. Q1 was a solid quarter in terms of volume for the company, showing 14% year-over-year volume growth, with a big tailwind coming from the Asia-Pacific region, which saw nearly 50% volume growth. And revenues, though, fell 2% during the quarter, largely due to lower selling prices and the negative impacts from foreign currency. Amgen has a great portfolio of both new and older stocks, which should help sustain the growth for the company moving forward. And in addition, obesity drugs have been quite popular, especially in the media of late, and Amgen has their own that they are working on that has seen great results. AMG 133 is still going through clinical trials, but the results have been quite positive. Amgen pays a dividend that yields 3.8%, which is near an all-time high for the company, which speaks to the company being undervalued, as dividend yield has an inverse relationship to stock price. The company has been growing the dividend for 11 consecutive years, and they have a 5-year dividend growth rate of 10%, making them a dividend growth stock as well. Shares of Amgen trade at a 2023 earnings multiple of 12.4 times compared to their 5 and 10-year average of 14.1 times, indicating the stock does appear undervalued. In terms of analyst price target ratings, they rate the stock a hold, but they also have a price target of $253, indicating 13.5% upside from current levels. July dividend stock number 3 is Visa, stock ticker V. And as you're probably already aware, Visa is one of the largest payment processing companies in the world today, as they handle more than 160 different currencies. Visa and MasterCard are the 2 largest in terms of credit card or payment processing companies, followed by the likes of American Express, which isn't as widely accepted across the globe as the first 2 are. Visa has a market cap of $466 billion, and over the past 12 months, shares are up 12%, and year to date, they are up 10%. The primary business model is pretty simple. Every time you swipe or use a Visa product, they charge a small fee. And when we look back to 2022, Visa was handling more than 700 million transactions per day. The company has allowed for not only fast, but secure and reliable payment processing, which has been the lure for Visa over the years. The company had a strong 2022 with revenues topping $29 billion and processing payments volume of more than $11.6 trillion. The company continued the momentum in Q1 2023 when they reported year-over-year revenue growth of 11%, which beat analyst expectations. The company also has a very strong balance sheet, which goes hand in hand with their AA- credit rating. When people invest in Visa, they're not really investing for the dividend yield, as the dividend yield has generally been quite low. They're more investing for the growth aspect of things. But the dividend isn't low by lack of dividend growth, because the company is actually a very strong dividend growing company. They are aggressive with their dividend growth, as we're going to look at here in a second. But if you recall, there's an inverse relationship between stock price and dividend yield. Over the past 10 years, shares of Visa are up over 425% compared to the S&P 500 total return of 225%. That just speaks to the strong performance shareholders have seen from Visa. Speaking of the dividend, Visa yields a dividend of just 0.8%, but they have a 5-year dividend growth rate of 18%. And in 2022, the company hiked their dividend by 20%, and another sizable hike may be in store for 2023 as well. The board has increased Visa's dividend for 14 consecutive years and counting. In terms of valuation, analysts are expecting 2023 EPS of $8.64 per share for the period ending in 3 months, which equates to a PE multiple of 26.2 times. But looking forward out to next year, analysts expect EPS growth of another 14% that following year, which equates to a 2024 earnings multiple of only 23 times for a fast-growing company. Over the past 5 years, for comparable purposes, Visa shares have traded at an average earnings multiple of 34 times. Over the past decade, closer to 29.6 times, suggesting the stock is looking quite cheap at these levels. I already own shares of Visa, but may be looking to add to my position here in the near future. In terms of analyst price targets, they actually tend to agree across the board, as they currently rate the stock a strong buy with a 12-month price target of $272.55, indicating nearly 20% upside from current levels. July dividend stock number 4 is Federal Realty Investment Trust, stock ticker FRT. FRT is a retail or a real estate investment trust, and they have a diversified portfolio of mixed-use and retail properties. FRT currently has a market cap of $8 billion, making it the smallest on our list today, and over the past 12 months, the shares are down 6%, and year-to-date, shares of FRT are down 8%. The company has a portfolio of 102 properties that are leased out to roughly 3,200 different tenants. The company focuses on suburbs right outside primary cities that have dense populations and higher income levels, as well as higher barrier of entry locations. 37% of the company's property operating income, or POI, is mixed-use properties, followed by 27% being super regional and 21% being anchored. Those are the top 3 in terms of POI. And in addition, 75% of all centers have some sort of grocery component to them. Here's a quick look at the company's top 10 tenants, led by TJ Maxx, which accounts for 2.7% of ABR, so pretty low in terms of the top tenant. Otherwise, no other tenant accounts for more than 1.8%, and only 8 tenants are above 1% ABR, making for a very diverse tenant group. The mixed-use portfolio does have an office component, which could worry some, but the office buildings that the company has are Class A, meaning they are the highest of quality, the best of breed in terms of location, which are still desired to this day. In terms of the dividend, FRT pays a high dividend yield of 4.8%, but that high yield comes with much slower growth at 1.6% annually over the past 5 years. However, the company is a dividend king, as they have increased their dividend for 55 consecutive years and counting. Looking at valuation, analysts are calling for 2023 AFFO of $4.92 per share, which equates to an AFFO multiple of 19.1 times, which is well below the company's 5-year average of 24.4 times and extremely well below their 10-year average of 28 times. In terms of analysts and their price target, they rate the stock a moderate buy with a 12-month price target of $105.64, indicating 12% upside from current levels. July dividend stock number 5 is Crown Castle Incorporated, stock ticker CCI. Crown Castle is yet another REIT on our list, trading at a great valuation, and they compete directly with the likes of American Tower, stock ticker AMT, which is another great REIT, trading at another great valuation. Crown Castle currently has a market cap of $48 billion, but over the past 12 months, the stock has been hammered. They are down over the past 12 months 36%, and year-to-date down nearly 20%. Crown Castle is yet another cell tower REIT that is seeing increased demand based on connectivity. Everything these days is so important to be connected through data. Here's a look at the company's portfolios. They have more than 40,000 cell towers, roughly 120,000 small cells, and roughly 85,000 miles of fiber. And over the past decade, the company has invested heavily in CapEx, and those investments are coming to fruition and expected to begin showing in the cash flow now. The cash flow will continue to help fund a high dividend yield that management expects to grow by 7 to 8% in the near term. The company's top tenants include the likes of AT&T, Verizon, and T-Mobile. In terms of the dividend, CCI yields a high dividend of 5.5%, the highest on our list today. And over the past 5 years, the company has increased the dividend by an average of 8.3%. The dividend has been increasing for 8 consecutive years. Analysts are expecting CCI to generate AFFO of $7.63 per share, which equates to an AFFO multiple of 14.6 times, compared to their 5-year average of 22.8 times and their 10-year average of 20.9 times. In terms of analyst rating, they rate the stock a moderate buy with an average 12-month price target of $149.30, indicating huge upside of 34% from current levels. So there you have it, 5 dividend stocks for you to consider for your portfolio for the month of July. We have a semiconductor company, which was a carryover in Qualcomm. We have Amgen, which is a biotech company, Visa, a payment processing company, and then we have 2 REITs in both Federal Realty as well as CCI, or Crown Castle. What I want you to do down in the comments section below, if you had to choose one of these, which of these stocks would you want to buy in the month of July? Let me know down in the comments section below. And if you haven't done so yet, please smash that like button, as it truly helps the growth of this channel. And with that being said, we'll see you in the next video. Take care.